Is a market crash even possible if we're missing 6.5 million homes? Well, I'm going to share with you data on 5 reasons why we are not going to experience a market crash. Come inside.
One shot, now the future is yours. Go!
It's a funny thing. We got the media right now, got everyone on their head thinking that the crash is coming. It's the worst time in real estate. They did the exact same thing in 2008. But let me tell you, the first 5 years after '08, I helped make my investors over $100 million. I told myself when this run is done, it's all gonna happen again. I'm gonna be even more ready. And this video is me officially coming out and telling you that there are 5 major reasons why we are not going to experience a real estate market crash. Here we go. To really understand if there's going to be a housing market crash, you need to understand what a housing market is. The housing market refers to the supply and demand for houses, usually in a particular country or region. A key element of the housing market is the average house prices and the trends in those home prices. On the right side here, we have all of these contributing factors to housing prices. We have interest rates, economic growth, number of households, availability of mortgages, speculative demand, affordability of housing, the number of homes selling, the supply of houses available, all the new builds, and someone's got to track all of this, which is what I get paid to do, so I can ultimately predict whether the market is going to go up or down. Can you really experience a market crash if homeowners are reluctant to sell their property? Homeowners are locked into low mortgages right now, and I want you to think what that means. Rates have gone up. Why would you sell and take on a larger interest rate when you've locked in something less? People are simply going to wait. Refinancing is at an all-time high. Affordability for buying is at an all-time low. Homeowners also use their increased equity to pad retirement and savings accounts, to pay off high interest credit card debt, and supplement living expenses as inflation grows. Bottom line is, we are not for sale. And if you remember what happened during the pandemic, there was this huge spike in demand for real estate because everyone's like, I'm probably never going back to work. I need a different house. I need a place where I can office out of at home, and that doesn't work with this home. But in this economy, guess what? People are basically saying, hey, that was more of a want than a need. So right now people are holding tight saying, hey, it's better just to do nothing and wait. Number 2, let's talk about credit availability. Right now it is super tight. Going all the way back to 2007, we're currently sitting at one of the lowest times for credit availability. In 2008, unsafe low credit mortgages were easy to obtain. But that's no longer the case. Now the 30-year fixed mortgage, that's the primary real estate product. So back in 2008, people are like, why did we experience a crash in the first place? That's because we had a few years where banks said, we're gonna provide you what's called a heartbeat loan. If you have a heart that beats, you get a loan. We also called them fog a mirror loan. If you can fog a mirror, then you also get a loan. In other words, you could do stated. You could state how much money you had. You could state how much money that you made. We had people that were making $50,000 a year claiming to make $150,000 a year, and banks just went with it. Well, guess what? You had a bunch of non-qualified people getting qualified for mortgages. That was the last debacle. Banks have learned their lessons. They tightened up on credit, and guess what? They haven't really loosened up at all since. Bottom line, the third reason we're not going to experience a market housing crash, the foreclosures simply aren't coming. You need foreclosures. That is like a key lead indicator that there's going to be a crash. Homeowners have far more home equity than in 2008, putting them in a good financial shape and allowing them to sell their property for a profit. According to CoreLogic's home equity report, individuals with outstanding mortgages in the United States experienced a 15.8% rise in equity during the third quarter of 2022, and on average, borrowers saw a gain of $34,300 in equity over the same period of time. If you own a home and it's gone up in value and your equity's increased, you now have a bigger asset. So if you're in financial trouble, why would you give your house back to the bank? Your house is an asset. You're gonna pull the money out of it and use it to pay off your debts, basically pad yourself, keep yourself safe. And by the way, if you have a home right now and you have equity in it, listen up, I wanna show you something real cool. Every day I help someone in the world use home equity to make a lot of wealth. It's called positive arbitrage. They get a home equity line of credit, which costs nothing. They access equity in their home, and then they use it to buy real estate. If you have a 401k, if you have an IRA, you can do the exact same thing. If you want to partner with me, or if you just want to have a free conversation, you can actually text me because I'm giving you my phone number right now. Just text 385-217-3477. Say, Kris, what's up? I got a financial question for you. Tell me about your finances. Tell me about your job. And basically just ask, Kris, if you were in my shoes, what would you do? Because I'll tell you. Reason number 4 or 5, mortgage delinquency rates, they're super low right now. What is a mortgage delinquency rate? It's when a homeowner is late on a mortgage. So if you take a look at the graph, you look at what's happened since 2010, that basically means after 2008, there was a crash and all of a sudden people were late like crazy. Check out the last time people were really late. There was a little bit of a bump in 2020 during the pandemic. Government kicked in some money, but outside of that, we're sitting pretty much at all-time lows. All of this translates to not having the environment for a crash. The 5th, and perhaps one of the biggest reasons why we're not going to experience a market crash, is because we are currently starved for inventory. Check out this graph right now. New home listings are at an all-time record low. Despite some improvement, new listings still lag behind pre-pandemic levels between 2017 and 2019 by 25%. And because there is still low inventory but really high demand, multiple factors such as inflation, affordability, and interest rates would need to combine to make home prices drop. Now you might be wondering, okay, Kris, if you don't think we're going to experience a crash, what do you think is going to happen to home prices over the next 2 years? Check this out. You've got all these hedge funds that are coming out of the woodworks, and they're starting to buy up all the single family homes. For example, Blackstone. Blackstone is one of the largest real estate investment funds. In April of 2023, Blackstone raised a record $30 billion in a single real estate fund. The fund, called Blackstone Real Estate Properties X, is 48% bigger than the asset management's giant previous real estate fund, which closed in 2019. In fact, the World Economic Forum predicted over the next decade that 10% of the current real estate market that is held by owners, people like you and I that buy houses, will be actually held by businesses, hedge funds. Follow your financial nose and your money will grow. And if you listen to what I'm telling you, right now you have over $50 billion being deployed in purchasing single family homes, because over the next 2 decades, those prices are going to rise like crazy. For example, what happens when we want a new president in the next 2 years? To gain popularity, that president is going to have to lower the interest rates. And when you are missing 6+ million homes, guess what that will do to the prices? It's going to inflate the prices of real estate. I'm buying as much real estate as I can right now. And if you're not, you should be. Check this out. You could keep your money in a 401k or an IRA, and with a 30-year average of 6%, it'll triple in the next 20 years. But if you put it in real estate, even just earning 25%, it doesn't triple. It grows 27 times bigger than that. Over 20 years, that grows into $4.3 million. If you grow it at the level I do real estate, that grows into $17+ million potentially. There is a link below where you can learn about partnering with me. In that link, I'll share with you my track record on my last $2 billion worth of real estate acquisitions, my last several thousand homes, and my average ROIs. If you want to kick retirement's butt and you want to do it the right way, but you want to do it hands-free, click the link, get with me and my team, or text me and ask, Kris, what does partnering with you really look like? I could be doing 100% of the work. We would be splitting the profits equally, but the bottom line is you can financially get yourself where you want to go. Thank you for watching today's video. Like, subscribe, share, do all those things. Please help me grow this channel, get the word out. And if you'd like to know what the internet on my channel thinks you're going to love next, click right here and I'll join you there.